Great. Good morning, everybody. Happy Wednesday. Welcome to SKC Office Hours. My name is Sarah Crom. I'm the managing partner of SKC. I hope many of you are repeat joiners on our office hours, but for those of you who are not, I'll go over a couple of ground rules to start off. We are recording this session. We do like to use it for future reference. We post it on our website and we share it with people who wanted to register and were unable to attend this particular session. So we are recording. I'd like to introduce Karen Donaway, our Director of Marketing at SKC. She is the host, letting you all in from the waiting room and managing questions. And then Andrea Diaz, my partner, also with the lovely brick background there, who will help me manage the chat and filter through questions as they come in throughout the program. So today we are here to talk about PPP forgiveness, specifically on the FTE full-time equivalent reduction for the forgiveness formula. So very interactive. We know everybody's going to have a lot of questions. I actually feel like I'm about to teach calculus, so it's going to be a whole lot of fun for all of us. That being said, you could either raise your hand if you're on video, and Andrea and Karen will kind of help me manage that. If you have a question, otherwise we encourage you to use the chat function, and also if you want to be anonymous, you can utilize that in the chat function as well. So without further ado, I'm going to open with just a couple of things that came out the week of August. Actually, it came out on August 8th when President Trump signed his 4 executive orders that got a lot of news headlines. So I'll start with going through some detail on each of those 4, and then we'll jump into some PPP FTE calculations. So the first executive order that came in on August 8th was the student loan extension. So when the CARES Act was originally passed, there was a moratorium on student debt loan repayments, and you had the option to defer. And with that deferral, you also had a zero interest situation. So anybody who was not employed and who wanted a deferral was able to do that. You could, of course, opt to continue making payments. And if you dumped excess principal, you didn't have zero interest. So a lot of people were able to pay off some significant principal on their student loans. So this executive order actually extends that same parameter. So a deferral of payment as well as zero interest on any particular accruing of that time period, extended through December 31st of this year. So that was set to expire in September based on the CARES Act. So the executive order extended it to December 31. Unemployment, a very polarizing issue. So as most of you know, we had the additional $600 a week that the CARES Act provided for. That expired at the end of July. This new executive order replaces the $600 with $400 a week. The interesting spin to that, there's a couple interesting spins. First being the 25% of the 400, so 100 of that weekly amount is expected to be funded by the states. That wasn't really exciting for many of the governors to hear, especially our governor. There's only been 7 states so far that have signed up to cover that $100. New Jersey is not one of them. New Jersey has come out and said that they will have to create a whole new infrastructure to be able to support making those types of payments on the unemployment side, you know, the software side of that. The other interesting part of that is at the federal level, those funds are actually coming through FEMA. They're not coming through traditional channels with unemployment, and they're not coming from the different kinds of funds that have previously existed and that we used to use the $600 for. It's coming from FEMA. So FEMA has never had to distribute unemployment funds before. So logistically on that side, it's going to be a challenge. That being said, I don't think anyone's gotten their $400, and we're not sure how that's going to play out either, but that was part of one of the executive orders. The third one is the eviction on renters. So there's a moratorium for renters who are in buildings that are federally backed mortgages. So if your landlord has a federally backed mortgage, there's a moratorium on your eviction. The details of that executive order talk about how the Treasury and the Housing and Urban Development Department are supposed to find funds to help support the renters and the landlords that hold the mortgages, so that we're not just going to fall into default. If, in other words, if the renters aren't paying, then the landlords can't pay their mortgages. How do we prevent default? So right now we're trying to keep everybody in their homes as they are, and then work on finding funding either on the renter side to pay their rent or on the landlord side to pay their mortgages. They were actually able to do this, just a quick sidebar, because they used the pandemic as a health and safety issue, that if people started to be evicted, they would have to go into more types of group housing, whether that was shelter housing or move in with family, and it would be too crowded for, being properly social distanced. So that was actually how they got this kind of pushed through. And then the fourth and final executive order, which is probably one of the most fun for everybody, is this payroll tax deferral. I saved the best for last. I want to emphasize the word deferral on this. So first of all, it applies only to employees. It does not apply to employers. So there's no benefit to the employer in deferring any cash flow. It's strictly a deferral for the employee. It's also only eligible for people who make $100,000 or less in a year. The deferral is supposed to happen from September 1st to December 31st of this year. A lot of questions with this. A, how is it going to be implemented? B, is the deferral going to require on January 1st, 2021 that everything gets paid back? What's the mechanism for the government to recoup everything that was deferred? Is it going to be through the employer's additional withholding? Is it going to be through the individual's 1040? A lot of unanswered questions here. Will the employees be able to opt out if they don't want to participate in this deferral? So a lot of our clients have been coming to us asking questions about it. We have sort of advised them to go to their payroll company, because that's the ultimate mechanism for how the employer withholds the money from the employee and then remits it to the government. But I will tell you that the payroll companies are just as uninformed as we are on what should happen next and how it's going to actually be implemented. And we're about 5 days away from it. So we were supposed to get guidance already from the Treasury on it, and we haven't, but we've got 5 days to go. So we'll see on that. So I'll pause for a second to see if anybody has any specific questions on the 4 executive orders that we just talked about. And then we can jump into the FTE calculations. Okay, seeing nothing and no flailing arms by Karen or Andrea, I'll assume we can go forward. So let's talk about the FTE calculation. The previous office hours that we did, we focused really on the forgiveness application, the EZ form. This is a little bit more complicated than that. We're going to dive into people who were reduced in either hours during a certain time period, or well, let me step back for a second. So there's 2 reductions that affect forgiveness. One is a reduction in compensation. So if employees who make $100,000 or less were reduced by more than 25%, that factors into the PPP forgiveness formula. We're not going to talk about that in detail today, because for the most part, that's essentially the calculation. We take the first quarter of 2020, and we compare that to your covered period, which again is the 8 weeks or the 24 weeks. And if people who make $100,000 or less were reduced by more than 25%, there's a reduction quotient that goes into your PPP forgiveness application. We can talk about that on the chat if there's specific questions, but for the most part, the complicated calculation, sort of the choose your own adventure version, is really with the FTE equivalents. So let's talk about what that is for the purposes of this. So there are 2 different levels of exemption from the FTE reduction. And we're going to talk about those and step through those. So the very first one, which is if these apply to you, then you're waived and absolved of what your FTE situation was. So if you were unable to operate between February 15th and the end of your covered period, and again, the covered period is whether you're electing 8 weeks or 24 weeks, starting from the day that you got funded, and you were not able to operate between February 15th, 2020, and the end of your covered period compared to the same level of operation before 2/15/20 because of COVID-19 guidance, and we'll talk about what that means, that was issued between March 1st and December 31st of 2020. If you were not able to open because there was an executive order, because of OSHA issues, because of an order issued by Governor Murphy, if you happen to operate in the state of New Jersey and you weren't allowed to be open, then your FTE calculation does not matter for PPP forgiveness. You can fill out the EZ form and you don't have to be subject to the rest of the calculations and hoops we're essentially going to jump through. You do have to certify this on the EZ application. You have to make the statement that pursuant to whatever the regulation or the ruling was, you were not permitted to be open. And again, it's between 2/15/20 and the end of your covered period. So for those who are using an 8-week covered period, that's 56 days. For the most part, I think a lot of us are using the 24-week period, so that ends up being 168 days. And they do count based on days, not by weeks. For most of us, the 24-week period, if that's what you're using, is not yet over, but you can still apply for forgiveness before the end of your 24-week period if you have exhausted all of your funds. If you do have FTE issues, we're going to talk about that. You may want to time when you apply for certain reasons. So to further talk about what does it mean that you weren't able to operate at the full level of operations from before February 15th, it doesn't say what that means. So there's no definition of, do I have to be fully closed? Do I have to be at 80%? Do I have to be at 50%? They strictly use the word at the same level of operations. So again, I mean, if we have any attorneys on the call, we could probably explain this 6 different ways and get to the result that we wanted. But for the most part, I would say if you had any reduction in revenue, or of course, if you weren't open at all, then this would apply to you. So if that doesn't apply to people, then we have to look at the FTE calculations that we're about to do. So I'm going to just talk before I get into the specifics of if we qualify for this, then that, of the calculation itself and what we have to actually be looking at to calculate FTEs. So what is not included in our FTEs? If we have anybody who's out or was out during the period on FMLA, so they were either out because they themselves were sick, they were caring for someone who was sick, maybe they were home because of childcare issues. If they took the FMLA that was passed through the CARES Act, they do not count against you in this FTE calculation. So we have to remember that as we go through. I'll do a screen share momentarily of a spreadsheet. They will not count against you in this. Also, what does not count against you as an employer in this calculation is if you were unable to hire people back. So let's say maybe you did some furloughs or some layoffs and then you got PPP money and wanted to bring people back. If you were in a situation where your team members did not want to come back and you couldn't find people to replace them, that also does not count against you in the FTE calculation. We've talked on previous office hours about documenting that and of course, sending out the ever famous let me see if I get it right, BC6 forms to the state for unemployment to say, yes, you've offered so-and-so their job back and they've declined. And we've also had some legal letters sent out to individual employees to document this as well. So if your team members wouldn't come back, that does not count against you. Same concept, if you had reduced people's hours, maybe everybody went down to 80% of their full-time schedule and they refused to come back once you offered them to go back full-time, that also does not count against you. Further, any employee who was fired for cause, obviously that needs to be documented, and any employee who voluntarily resigned or requested a reduction in their hours, that also does not count against you. So again, we need proof of all of these things to substantiate the calculations that we're about to do on the FTE side, but those are things that you have to hold in your records. They aren't things that get submitted when we fill out the application. So we have to keep all of these things for 6 years, all of this proof, all this documentation, but we don't have to submit it with the application. So let's talk about the calculation of the FTEs. Let me see if I can do a quick screen share here. It's a very basic spreadsheet. So Karen, I can see you on screen. Can you just nod your head if you can see what my spreadsheet is? Okay. So the FTE calculation is going to be the same way we calculate it for all of these different time periods. It needs to be done by employee. So I put this together just very quickly to try to illustrate what it needs to look like. Obviously, there's only 6 employees. And again, I'm assuming we're at a 24-week covered period here. So we have to take, each of these is the number of actual hours worked by each employee per week for the 24 weeks. And this is, if you can't have your payroll company generate a report like this, this is essentially what we'll be creating to do these different calculations over the different time periods that we have to look at it for. So it goes all the way over to, let's see if I can get it to move further, to the 24 weeks, and then we have a weekly average here. So what is that weekly average? Basically, we're taking the average hours by week by employee for 24 weeks, and we're dividing that by 40. So we're using the full-time equivalent of 40 hours a week. So I basically summed week 1 through week 24. Obviously, it divides by 24 to get the average, and then we divide that by 40 to get the ratio. And there's 2 ways to utilize the ratio here. No one can be greater than 1. So if you have somebody that comes out and does a lot of overtime, or maybe you had employees that couldn't work, and so some of your employees that did work had overtime hours, that can still only be capped at 1 FTE. So we do the calculation and see, you can see some come in at 0.9, some come in at 0.6, some come in a little over 1. What we have to do is round to the nearest 10th. So there's 2 options here. I used the simplified version that they allow you to do, which is basically anybody that is 1 or greater automatically becomes a 1, which you can see here for each of these. And then anybody who's not a 1 can automatically be given a 0.5. So that's the simplified version of the calculation. You can also utilize actual numbers, which again, because they wanted us to round to the nearest 10th, we would be rounding to that. So we would have some people being 0.9, 0.6. Again, our 1s can only be as high as 1. And then you would take the total of each of these. So for all of these calculations, because everybody's situation is going to be different, and you have to be consistent in how you apply it. So in other words, we're going to take certain periods and compare it to other periods for the FTEs. You have to use the same calculation. So you can't decide to use the simplified method on option 1 and then on option 2 use the actual calculation of 0.9, 0.6, 1 that comes out. So what we're advising clients to do, unless you have a true sense of which is going to be better for you, do all of the calculations both ways so that you can understand which is going to be the better option for you. I've done a couple of these with clients already. For the most part, what I have found, which again, everybody still should do their own calculations under both versions, is that the 1 or the 0.5 is actually helping clients by a slight margin. But of course, that's a handful of people and certainly not statistically sound enough to say that's what everybody should do. So my suggestion is to run it both ways so that you can see which is better. But essentially, that's how we're doing the calculation for all of these periods. Now, some of the periods aren't 24 weeks that we're comparing to, but I wanted to show you for the covered period how you would be doing this. A question that may pop up is, what do we do if we've exhausted our funds before the end of 24 weeks and we want to apply? Do we still use the whole 24 weeks to get the average? So that answer is no. So let's say that we're in week 17 here and you've exhausted funds and you, for whatever your reason is, you want to apply. You would run this same calculation, but only through 17 weeks because you're not going to have that data to go all the way through the 24 weeks, which for the most part, I think takes us to September, October. You're not going to have that data yet. So you're only going to run it through and do the calculations through the 17 weeks, the date of application for forgiveness. So I will pause here and stop sharing my screen to see if anybody has questions just on how we calculate it. Because again, this is going to be what we use to get us through all of the different safe harbors and all of that. So I'll pause for, go ahead, Anj. I actually can't hear you. So, Karen, could you hear her? Okay.
Mm,
There we
Can you hear me
go.
now?
Now I can hear you, yes.
Okay. Um, if we're comparing to prior periods, such as, in 2019 and in some of these, do we have to do the same type of calculation for the 2019 hours and we can use either method, simplified or the weighted average?
Correct, but you have to be consistent in the application of either the simplified or the average. So you can't take your 24-week covered period and use the simplified method and compare it to a 2019 timeframe and use the actual weighted numbers. You have to be consistent in using those calculations.
Sarah, so is there a downside to putting the forgiveness application through if you've exhausted all funds by 17 weeks?
So a downside, not that I can tell, but what I will say is there's still so many unanswered questions. There's questions on the taxability of the expenses. There's questions on, well, I shouldn't say there's questions. There's rumors that any loan that's under 150,000 will be automatically forgiven. There's sort of all of this stir that's out there. And most of what I think is going to come out in the future, if clarifying guidance or new regulations come out, will be pro-business. So part of me is saying, what's the hesitation? Maybe we should wait. Again, we talked at our previous office hours, there's 60 days from the date that you apply to the bank that the bank has to go through everything and approve it. And then they submit it to the SBA, and then the SBA has 90 days to go through their process and approve it. So combined, if they max out, it's 150 days, which we talked about before we opened up the waiting room this morning, that basically we're already at that mark. So even if you applied today, from now until the end of the year is 150 days will push us into 2021. So if the SBA and your lender decides to go out that full course, then you're not going to have an answer on the forgiveness until 2021. And there's tax implications, there's financial statement implications to that if you have a situation where you're issuing financials. So it's really an individual basis, I think, if you really do want to apply early. I mean, that being said, some banks still aren't even accepting applications. I had a client the other day through Bank of America. Bank of America said, we're not accepting applications yet. So in that situation, some people's hands are tied by what their lender is, whether their portal is open or not. Now, other banks are actively asking their business clients to apply because they don't want to get the deluge of applications that they have to process within 60 days all at one time. So it's really on an individual basis. I mean, Andrea, I don't know if you want to add to that. My gut feeling is there's no rush to apply.
I think the only caveat to that would be if you know that you have full staff right now and you anticipate having to furlough or lay off towards the end of the year, you want to apply while you have a full staff. So because you have to put on your application how many employees you have of now. So if you've exhausted your funds after 17 weeks, and at 17 weeks you still have full staff and you haven't let anybody go, but you anticipate that potentially in week 23 you may have to, or later, anytime after that, if you apply now or apply at the end of your 17 weeks after you've exhausted the funds and when you have full staff, you won't have a reduction in FTE.
Right, and that's the planning point coming out of this office hours is where are you with your FTEs? Because there's a couple of options of when you can apply if you don't qualify for these safe harbors that we're about to go through.
And Sarah, we do have a question in the chat.
Go ahead.
We pay monthly. Can we use month totals?
So I don't know if that's dollars or hours. On the FTE calculation, you need to use weekly. Even for employees that pay on a biweekly, which is I know how SKC pays, you still have to do the average weekly. So the hours need to be broken out on a weekly basis for that FTE calculation. I hope that answers that question. I think that's what that was asking. Okay, so let's jump into some of the safe harbors. What we had talked about before was if you were unable to operate between 2/15/2020 and the end of your covered period as the same level before February 15th, 2020, that allows you to use the EZ form and you don't have to worry about any of the FTE calculations that we're about to go through. So that's step one of the safe harbor. If you weren't operational and if you weren't operating at the same level as before February 15th, then you don't have to go through these FTE hula hoop jump ropes. The second part of this, the first step one of safe harbor is, okay, so let's say that your FTEs were reduced between February 15th and April 26th, right? So these are the dates that are built into the CARES Act and the forgiveness formula and the FAQs that have come out from the SBA. So if you reduced people between February 15th and March 26th, and you know that you restored these FTE numbers no later than December 31st, and they compare that, right? Because you're looking at February 15th to April 26th. So we could have a lot of variances between what our FTE calculations might be within that time period. They compare it to the payroll period that covered February 15th, 2020. So let's talk about people that are paid weekly, biweekly, and monthly. So you have to go back to your payroll records and find the payroll period that covered February 15th. That week, and I don't even know what day of the week that is, but if you go back and look at February 15th, 2020, and that week, that is how we are calculating the comparison of whether or not we increased our FTE levels by December 31 of this year to an acceptable level. So again, this is what I think Andrea was alluding to. If you need to wait until December 31st because you may not have restored your FTEs yet, and you know that you may not be able to restore them until the end of the year, you really can't apply until after December 31st, because we need to provide what were those FTEs at that date. And we can't do that until we get there. So it's kind of why there's a little bit of wiggle room of when people are going to apply. Now, if you're at the end of your 24-week period and you know that you have restored your FTEs, you can apply. If you have exhausted your funds and you know that you've restored your FTEs before the end of your 24-week period, you can apply and not suffer from any reduction on the FTE side. So that's the other safe harbor, where if you can prove simply that you know that you reduced people between February 15th and April 26th, but you're able to compare anything after April 26th back to the 2/15 pay period, you're exempt from having to do this calculation. So if you don't qualify for any of these, we have to move back to the original options that we talked about when the CARES Act first came out. But for now, I'll pause and see if there's any questions specifically on the safe harbor. Because again, I said, it's like teaching calculus and a choose your own adventure. If, you know, what do we want to do and how do we want to figure this out? And there's a lot of moving parts. So on the safe harbors, the two options, does anybody have questions there? Okay. So if we're in a situation that neither of the two safe harbors apply, then we need to go back to the original application on the CARES Act, the original two options and comparison periods that we used, which for those of you that don't remember, we had the option as the business owner, and we still have the option between choosing two comparing periods. So we can either choose to compare 2/15/19 through June 30th, 19, or we can choose January 1st, 2020 through February 29th, 2020. And again, we're going back to the same FTE calculation when I shared the spreadsheet, using the same, whether you're using the simplified method of 1 or 0.5, or if you choose to use the actual calculated average. So we're, again, calculated all four ways, both both timeframes, both ways, and see what gives you the, essentially here you want the lowest amount because you want to make sure that you have restored as many of your FTEs as you possibly can. So we're doing the week by week, employee by employee calculation for each pay period, for each option here. And then you're going to decide which one, again, is lower, if it's February 15th, 2019 through June 30th, 2019, or if it's January 1st, 2020 through February 29th, 2020. And then we're going to compare that to the FTEs during the covered period. Again, either the 8 weeks or the 24 weeks. So if you know, I mean, I have a couple of clients who just know they're not going to restore their FTEs by the end of December. So they're just, for whatever reason, they're not going to be able to do it. You need to determine now when you want to apply, because you're going to fall into this last category here where we're comparing the two option periods with the time period of application within your covered period. So again, this goes back to, let's take a 24-week covered period. Are we going to wait the 24 weeks and see what our FTEs are then? Are we going to stop at week 16 because we know we've exhausted our funds and we can apply at this point? Or are we going to wait until week 18 because we think our FTEs will be better then? How are we going to play with that? Again, the timeline for this final reduction quotient does not take you to December 31st. So you're only eligible to use that December 31st date if you absolutely know that you're going to qualify at that point. So if you don't know that you're going to qualify for a restoration of FTEs by December 31st, then then for this calculation, you can only go through the FTEs of your, through the end of your current period. So you can only go up to 160 days after the day that you got funded for the FTE calculation for this quotient reduction. So it is a business decision. It is trying to predict, trying to have a crystal ball and understanding what's going on in your specific business, in your industry. If there's any element of seasonality to your business, if you think that you're going to be where you need to be at December 31, or if you know that you're not and you know that you have layoffs or furloughs in the future and you want to get your application in before you do that so you lock your FTEs in. It's a case-by-case basis on kind of playing the game of when is the best time to make these, submit these applications and do these calculations. I mean, for the most part, you can sit here and do all of the different calculations and keep a running average, you know, for all of your weeks as they tick by and have that in real-time data. But we are going to have to make some assumptions going forward on, is it safe to apply yet? Should we wait till the end of the 24 weeks, or do we ultimately think we can get there by December 31st?
I have a question, Sarah, just to summarize it. Would it be fair to say that if I'm an employer who had to furlough or lay off through this, and not because I was closed, so, you know, just because of traditional business revenue is down, I have basically three options to bring them back by the end of my 24-week period, by December 31st, or by the week that after I've exhausted funds. So if I've exhausted funds by week 17, I have to bring them all back by week 17 at the same salary.
Correct.
Those are my three options, basically. By the time that I'm applying, by the end of my 24 weeks, or by December 31st.
Correct.
Okay.
Correct. And if I'm going to say, if you roll the dice, right, and you wait to see if you can get there by December 31st and you can't, then the calculation ends up being where you were at the end of the 24-week period. So if you get to the end of the 24-week period and you're like, I think I'm going to roll the dice and see what happens on December 31st, you can take a snapshot in time at the end of that 24-week period of your FTEs, and that's going to be your worst case scenario from a reduction standpoint.
And they all have to be back at 100% of their, or basically at 100% of their salary.
Well, I'm not talking about salary yet. I'm just talking about,
okay. Right.
I'm just talking about FTEs,
Got it.
not
Okay.
money, hours. So yes, I mean, if you don't want to get a reduction when you're going through these comparative periods, you obviously always have to be higher than where you were or equivalent to where you were in these option periods of February 15th, 19 through June 30th, 19, or January 1, 2020 through February 29th, 2020. But some people won't be able to get there. So then the strategy is, well, what can be the least amount of decrease off of that 100% of where we want to be, right? And what are those different timelines in the coming weeks and months that will get us as close to 1 as we want, because that's how this is ultimately done. When we do it on the application, it becomes a reduction quotient. So it's, you know, if you can only restore 98% of your FTEs in your comparative period, you're going to have a 2% reduction on your forgiveness formula. I mean, that's essentially how the math works once we get to that point. So to minimize what that percentage of reduction is, if you're not going to restore it back and have full forgiveness, that's the ultimate goal here. And I recognize people are in different situations where not everybody may be able to get back to the 100%. This is a lot to take in, isn't it? Karen, I don't know if you want to send out that very basic spreadsheet that I put together just so people can play with it and use it. Happy to send it to you and make sure everybody that's on this call gets it. If nothing else, it lets you visualize it and play with it in real-time numbers for your business. Any questions overall on this? Again, I know it's a whole heck of a lot to try to take in and understand. So I just go ahead, Karen.
So can you just go back to when you were talking originally about keeping the documentation if you had people on FMLA, et cetera. So you basically put in the forgiveness application just with that information, with no backup, and you hope for the best, or you just like, what happens?
Hope's not a strategy, Karen.
No, there's no like PDFs you have to upload or anything like that?
So again, on the payroll side, great question, because there's a whole page on the instructions of documentation that you need to have, and it's split out between what you need to submit and what you need to actually just have and hold for the 6 years. The primary support for all of these FTE calculations, et cetera, is really going to be your payroll reports. And there is a spreadsheet that you're going to have to submit with the application that does show people's salaries as well as the FTE calculation, because it's going to be too challenging and cumbersome for them to get that themselves off of your payroll reports. They do give a worksheet on the application. It's not really that great, and certainly nobody's going to sit there and enter all the information on a PDF, which is why we created the spreadsheet. But you don't have to give any of that documentation. You don't have to give proof of who's on FMLA. You don't have to give legal letters if you sent job offers for people that declined. You don't have to send copies of BC6s that you may have sent to unemployment saying that, you know, we offered John Doe his job back and he declined, so therefore, you know, he had an offer, he shouldn't be on unemployment. You don't have to send, you know, Sally got terminated for cause. You don't have to send proof of that, but you do have to keep all of that, because the SBA reserves the right to come back and audit for a 6-year period. So that documentation will all need to be provided if you do get audited. I didn't mention this, but this is relevant. Anybody that has a loan over 2 million is automatically going to be audited. So you really want to make sure that all of this documentation is buttoned up, because at some point somebody's going to come and want to see all of that backup. And you're going to need to provide all of that at some point. But if you have a loan under 2 million, you just have to keep it in your records. The other thing is all of the calculations don't need to be submitted. You're basically filling in only 2 pages essentially of numbers. Actually not even, it's 1 page of numbers, and the first page is really all business information. And all of your supporting calculations, all of your spreadsheets, everything stay in that folder of things that you need to keep, but you don't need to submit. So the only things that you're submitting are basically the first couple pages of the application and then actual payroll records, talking about the payroll side of things. I'm not getting into, utilities or rent or that kind of thing for this. So it's going to be payroll reports run very specifically by these dates. It's going to be quarterly payroll returns. Some of the bigger payroll companies I know have specific reports that you can run for PPP. So if you happen to have one of those bigger payroll companies, you could probably just generate their PPP forgiveness reports. And that's really what's going to be submitted with the application. Everything else stays in a file for 6 years to support it if anybody ever comes and asks for it.
So another question for you. Thank you for that, Sarah. So
Yep.
if it happens that all loans under a certain amount are going to be automatically forgiven, would those people still have to submit forgiveness applications?
Great question. I have no idea. My guess would be no, because as it is, I think that the lenders and the SBA, as we were on the front side when we requested funding through the application process, people are just going to be inundated. All of our banking colleagues worked over Easter and around the clock and hired consultants to help them put all of the applications through on the front end of this. And that's basically going to be magnified because the forgiveness piece is a little bit more complex than just the application side of it. And most likely it's more intense for them because for the banking, it depends on whether they're going to get fully funded by the SBA for these loans or not. So I would not suspect that if they offer you the full forgiveness for anything that's under 150, that there will have to be an application process. They should probably, if they ask my opinion, just send everybody a letter and say, we'd like to just let you know that your loan is forgiven. I can't imagine they're going to have people jump through these hoops for no reason. But again, all of this is unpredictable. And of course, as we get closer to November and the election, things are kind of just in a stalemate in Congress now with getting any further clarification on any of these points. So everybody's guess is as good as mine. I wish I had a line right into the heart of who is making these decisions, but all I can go off of is what I've seen for the last couple of months so far.
To touch on the, I'm sorry, there was a question in chat. Go ahead, Sarah.
Sarah, so is 61620 the most current version of the application? And how do you reflect the exemptions on the application? It seems you just show no reductions.
Okay, so great questions. As far as I know, 616 is the most recent application. I hope that answer is correct. They did, the last change that I think they made is they took the original applications, which were like 12 and 13 pages, and split them between the actual application and the instructions. And I do believe that 61620 was the most recent time that they did that. The election, I guess, of the exemptions. So I guess it depends on which exemption you're applying for. If you are getting the exemption that allows you to use the EZ form for the forgiveness process, then there is a certification on that application that you basically sign off an initial and then you check the box of which applies to you. Either you didn't reduce anybody at all, or you weren't open and you are exempt from that. You check which one applies to you and then you certify that as part of the EZ application. If you're going through a couple other of these safe harbors and they walk you through that on the regular application, there is also the option to put 1.0. So if you go through all these gyrations on the complicated form, I'll call it, not the easy one, and you determine that you have no FTE impact, there is no reduction for you, you just put 1.0 in the line that asks for the FTE reduction quotient, and it doesn't reduce your forgiveness amount at all. So ultimately, if you get to the end and you realize, hey, this doesn't apply to me, you just put 1.0 in the line that it instructs you to for the FTE reduction.
And Sarah, we did have another question that had come through initially, and that was, will exceptions be made on forgiveness for part-timers struggling with childcare issues, not making their usual hours by 12/31?
So if they have elected the FMLA, which was enhanced and amplified through the CARES Act, they will not negatively impact the FTE calculation. If they are just opting or choosing to not work full-time because they can't because of childcare issues, that still has to go into your FTE calculation, unfortunately. So in order to get exempted from those individuals negatively impacting your forgiveness, they would have to formally go out on FMLA, which again is a shortened period of time. I mean, it's not forever. And I know a lot of people took it at the beginning of this when schools went virtual at the end of last year, and now schools are reopening again. And I think people are finding themselves in a similar situation to that. But of course, you can only go through the FMLA process once. So it is a challenge, and unfortunately, it will still impact you if you haven't replaced that person with somebody to compensate for those hours.
So I was just thinking maybe we could send also like a summary of the comparison periods, because I know there are a lot of dates, and I'm sure, I mean, I get confused with the dates and I read this stuff all the time, and when am I comparing to what? And I know we have kind of an outline, so maybe we can somewhat summarize the comparison periods for FTE for safe harbor purposes or calculation purposes with the spreadsheet that we send out, so that people can see without having to read the full instructions.
Yes, we can go through and say, here's your first safe harbor option, your second safe harbor option, and then here's sort of worst case scenario that you're going back and comparing to the original 2 option periods. That's a good idea, because as you all see, I'm looking at my other screen to remind myself what the dates are, because I don't want to mess it up. It's too important. Any other questions coming through that maybe don't pertain to the FTEs? I'm happy to field some of those as well for anybody that has questions on just applying overall.
Too many questions, Sarah. There's just too many. They're speechless.
Listen, I warned you. It was like learning calculus this morning. I wish it was different.
Tough one.
I'm going to wrap it up then, Kara, unless there's anything else you want to touch on.
No, other than, stay tuned. Hopefully going forward, we're going to be able to have some really awesome office hours on topics other than PPP, but we know it's on everyone's minds right now. And that's why we've dedicated so much time to getting this information out to you. So hope that you've found it helpful.
Absolutely. And if you do have questions that come up as you go through this, or as you get the handouts that Karen will send out by the end of the day, please feel free to email us if you have specific questions, because again, this is such an individualized situation for each business that it's so hard to kind of cover every potential scenario and walk everybody through it on a group call like this. So feel free to reach out to us, and we'll either jump on the phone with you, or we'll do an email back to you on solving some of these more customized situations that we find ourselves in. Other than that, please have a wonderful day, stay safe and healthy, and thank you so much for joining us today.